Welcome to Living Fire's feature-length film, Personal Finance: The World in One, the ultimate guide to managing your finances. In today's fast-paced and ever-changing world, it's crucial to understand the ins and outs of personal finance. From debt to investments, we'll be covering all the key concepts and strategies you need to know to make smart financial decisions. We'll start by exploring how the corporate world can help you manage debt and how to approach credit, including the pros and cons of using credit and debit cards. Next, we'll dive into the world of investments, where you'll learn about stocks and the benefits of reinvesting dividends. Debt is an amount of money owed by one person, organization, or country to another. It can be in the form of loans, credit card balances, mortgages, or any other type of financial obligation. Debt occurs when an individual or entity borrows money with the understanding that they will repay it with interest over a set period of time. If the debt is not repaid on time, it can have serious consequences, including damage to credit scores, wage garnishment, and even legal action.
I need another extension on my mortgage payments.
I understand that, Mr. Simpson, but according to our computer, your credit history is not good. It says here that you've been pre-declined for every major credit card. It also says that you once grabbed a dog by the hind legs and pushed him around like a vacuum cleaner.
I was in the 3rd grade.
Well, it all goes on your permanent record.
It's important to carefully consider the terms and conditions of any debt and make a plan to repay it in a timely and responsible manner. It depends on your individual circumstances and the amount of debt you have. If you have a manageable amount of debt and feel comfortable negotiating with creditors on your own, you may be able to successfully negotiate a payment plan that works for you. However, if you have a significant amount of debt, or if you're struggling to make payments and are in danger of defaulting...
Good, Lois. He's in complete denial. Like people in massive debt.
Well, honey, I've extended our line of credit and exhausted all our savings. We should be good for another month.
Oh, that's great, honey. Well, what are we going to do next month?
It may be wise to seek help. A financial advisor, a debt restructuring firm, or an attorney can provide you with guidance and support, and may be better equipped to negotiate on your behalf. Additionally, if you're struggling with debt due to a financial hardship, such as a job loss or medical emergency, a debt restructuring firm or attorney may be able to help you find solutions that take your unique circumstances into consideration. In summary, seeking help with debt negotiations can be beneficial if you have a large amount of debt, are in danger of defaulting, or are facing financial difficulties. A professional can provide you with guidance, support, and access to expertise that can help you reach a better outcome. Corporate approaches to negotiating restructuring of personal debt typically involve creating a payment plan that is feasible and manageable for the debtor, while also taking into consideration the interests of the creditors. This can involve reducing the amount owed, lowering the interest rate, extending the repayment period, or a combination of these approaches. The goal is to reach an agreement that allows the debtor to repay the debt in a way that is sustainable and manageable, while also ensuring that the creditors receive a fair return on their investment. A restructuring firm is a professional service firm that specializes in assisting companies or individuals in financial distress to reorganize and improve their financial situation. This can involve negotiating with creditors to reduce debt, improving operations to increase revenue and profitability, or selling off assets to raise cash. The goal of a restructuring firm is to help its clients overcome financial difficulties.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
And return to stability and growth. These firms typically employ experts in finance, accounting, and law who can provide strategic and tactical advice to clients in order to help them navigate the complex process of restructuring their finances. An attorney can play an important role in helping you resolve your debt. They can represent you in negotiations with creditors to help you restructure your debt and create a manageable payment plan. In these negotiations, an attorney can ensure that your rights are protected and that any agreements reached with creditors are legally binding. If necessary, an attorney can also advise you on whether bankruptcy is the best option for resolving your debt and guide you through the process.
Now, Pramila, I know it's scary in that there witness box, but tain't no need to fear me. I'm sorry, I thought you was corn.
Additionally, if a creditor takes legal action against you, an attorney can represent you in court and advocate for your interests. By providing legal guidance and support, an attorney can help ensure that you make informed decisions about your financial future. A financial advisor can be an invaluable resource when it comes to managing debt. They can assist you in several ways by first assessing your financial situation and helping you understand your current financial position.
Dad, what happened to the back seat?
I had to sell it for gas money, which I spent on a novelty horn.
Maybe we should talk to a financial planner.
Financial Panther, eh?
Mr. Simpson, you're $1 overdrawn.
Get him, Sheba! I'm on board.
This includes working with you to create a budget that takes into account your income and expenses and prioritizes paying off your debt. In addition, a financial advisor may be able to negotiate with your creditors on your behalf to reduce interest rates, lower monthly payments, or extend the repayment period. They can also advise you on debt consolidation options, such as taking out a personal loan or using a balance transfer credit card, which may help simplify your debt and reduce interest charges. Finally, a financial advisor can provide financial education and resources to help you develop healthy financial habits and avoid debt in the future. With the support of a financial advisor, you can receive expert guidance and support as you work to resolve your debt and regain control of your finances. They can help you understand your options, develop a plan, and take the necessary steps to improve your financial situation. A financial advisor, attorney, and restructuring firm each provide different services and approaches to help with debt. A financial advisor provides broader financial advice, including budgeting, savings, investing, and debt management. They can help clients assess their financial situation, create a budget, and develop a plan to achieve their financial goals, including paying off debt.
Lannister always pays his debts.
An attorney specializes in legal matters and can provide advice on debt-related legal issues, such as debt collection, bankruptcy, and debt negotiation. They may also represent clients in court or negotiate with creditors on their behalf. A restructuring firm specializes in financial restructuring and focuses on improving a client's overall financial situation. They may help clients negotiate with creditors, improve operations to increase revenue and profitability, or sell off assets to raise cash. Restructuring firms typically employ experts in finance, accounting, and law who can provide a comprehensive and integrated approach to resolving financial difficulties. In summary, each professional provides different services and approaches to help with debt, and a client may choose to work with one, two, or all three, depending on their individual needs and circumstances. A financial advisor can provide general financial advice, an attorney can provide legal advice and representation, and a restructuring firm can provide financial restructuring services. Negotiating your debt is an important step towards resolving your financial issues and getting back on track. Woohoo! It involves communicating with your creditors to reach an agreement on how you will repay what you owe. To successfully negotiate your debt, it's important to follow some key steps. The first step is to gather information about your current financial situation and the amount you owe to each creditor. This will give you a clear understanding of what you need to work on. Next, prioritize your debts by focusing on negotiating the most pressing debts first, such as those with the highest interest rates or those that are in danger of being sent to collections. Once you have gathered all the necessary information, reach out to your creditors directly, either by phone or in writing. Explain your financial situation and request a modification of your payment plan. Propose a specific, realistic plan for repaying the debt, such as lowering the interest rate, extending the repayment period, or making smaller payments. Negotiating with creditors can be a complex process, so be prepared to be flexible and open to finding a mutually acceptable solution. Communication is key, so be patient and persistent, and be willing to work with your creditors to find a solution that works for both parties. Finally, make sure to put the agreement in writing and keep a copy for your records. In conclusion, negotiating your debt requires patience, persistence, and a willingness to work with your creditors. By following these steps, you can communicate effectively with your creditors and find a solution that works for both parties. When considering debt restructuring, it's important to have a comprehensive understanding of your current financial situation. This includes understanding your debts, interest rates, and any associated fees with restructuring. It's also important to consider the options available for consolidating your debts into one payment, as well as the potential impact on your credit score and monthly payments. Another important factor to consider is the possibility of negotiating lower interest rates with your creditors, as well as the options available for debt relief programs such as debt settlement or a debt management plan.
What's he doing? He's paying for everyone's debts.
Additionally, it's crucial to understand the support and resources available to help you through the restructuring process, including the possibility of working with a debt counselor or financial advisor. By asking these questions and thoroughly understanding the answers, you can make an informed decision about the best way to restructure your debt and achieve financial stability. You can also determine if making extra payments without incurring a penalty is possible, and if closing existing credit accounts is necessary as part of the restructuring process. Debt consolidation is a method for managing multiple debt obligations by bringing them together into a single payment.
Herding cats. Don't let anybody tell you it's easy.
There are several options for debt consolidation, including balance transfer credit cards, personal loans, home equity loans, debt management plans, and in severe cases, bankruptcy. A balance transfer credit card allows you to transfer multiple high-interest credit card balances to a single card with a lower interest rate, reducing your monthly payment and saving on interest charges. A personal loan can be used to pay off multiple debt obligations like credit card balances, medical bills, or personal loans, and may have a lower interest rate than your current debts. Home equity loans, available to homeowners, can use the equity in your home to secure a loan to pay off multiple debt obligations, with interest rates typically lower than personal loans or credit cards, making monthly payments more affordable. A debt management plan is a repayment plan where you make a single monthly payment to a credit counseling agency, which then pays your creditors on your behalf. This plan typically involves negotiating lower interest rates and waiving fees with creditors. Bankruptcy, on the other hand, should only be considered as a last resort option, as it can have a severe impact on your credit score and be difficult to recover from.
I declare bankruptcy!
It is crucial to thoroughly consider the terms and conditions of each debt consolidation option before making a decision, and to seek professional advice from a financial advisor or attorney if necessary. The right debt consolidation strategy will depend on your individual financial situation, the amount and type of debt you have, and your overall financial goals. When considering debt consolidation, it's important to have a clear understanding of your current financial situation, including your debts and interest rates. Asking the right questions can help you make an informed decision about the best way to combine your debts into a single, manageable monthly payment. Some questions you may want to consider include: what is the interest rate on the debt consolidation loan, and will it be fixed or adjustable? Will there be any fees associated with the loan? How long is the repayment term, and will it result in a lower monthly payment? It's also important to consider the potential impact of debt consolidation on your credit score, as well as its impact on your ability to take out new loans in the future. Additionally, you may want to explore other debt relief options, such as debt settlement or a debt management plan, and understand the terms and conditions of these programs.
If you want to cross a bridge, my sweet, you've got to pay the toll. Take a gulp and take a breath and go ahead and sign the scroll. Flotsam, jetsam, now I've got her, boys. The boss is on a roll. This poor, unfortunate soul.
Finally, it's important to understand the support and resources available to you throughout the debt consolidation process, including the ability to make extra payments without incurring a penalty. The Snowball Financial Method is a debt repayment strategy that prioritizes paying off smaller debts before larger ones. The aim of this method is to provide a sense of accomplishment and motivation to the individual to continue paying off their debts. To follow this method, the individual should first create a list of all their debts, including the creditor, interest rate, and balance. Then, the debts should be ordered from smallest to largest, disregarding interest rate. The focus should then be on paying off the smallest debt by making the minimum payments on all debts, but paying extra towards the smallest one until it is fully paid off. This process should then be repeated for the next smallest debt until all debts are paid off. The snowball method of debt repayment has gained popularity for its ability to provide a sense of accomplishment and motivation as small debts are paid off. However, this strategy is not without its drawbacks. One of the main limitations of the snowball method is the potential for higher interest charges. By focusing on smaller debts, you may end up paying more in interest over time, especially if you have high-interest debt that is not addressed as quickly. Additionally, it may take longer to pay off high-interest debt, which can result in additional interest charges. Furthermore, the snowball method may not be the most effective strategy for everyone. If you have high-interest debt, it may be more cost-effective to focus on paying that off first, rather than starting with smaller debts.
'Cause I have $30,000 in credit card debt. When they call, I tell them I can't pay it back yet. Credit card debt. Tomorrow I may buy myself a dining room set or this Boba Fett. Credit card debt, credit card debt, credit card debt.
This can lead to feelings of frustration, as the debt that is accruing the most interest may not be addressed as quickly. It's important to consider all your options and choose the strategy that works best for your financial situation. The snowball method may be a good fit for some people, but it's not the only option for debt repayment. The avalanche method is a debt repayment strategy that prioritizes paying off the debt with the highest interest rate first. The objective is to save money on interest charges in the long run by paying off the most expensive debt as soon as possible. To follow the avalanche method, start by creating a list of all your debts and their respective creditors, interest rates, and balances. Next, order the debts from the highest to lowest interest rate. The focus should be on paying off the debt with the highest interest rate first, while making minimum payments on the other debts. Once the highest interest debt is paid off, use the extra money to pay off the next highest interest rate debt. Repeat this process until all debts are paid off. While the avalanche method can be an effective way to save money on interest charges, it may take longer to see progress and pay off your first debt compared to the snowball method. However, it is a more cost-effective approach in the long run and can help you get out of debt faster. The avalanche method is a debt repayment strategy that prioritizes paying off debts with the highest interest rates first. While this approach has the potential to save money on interest charges, there are some drawbacks that are worth considering. One of the drawbacks of the avalanche method is that it may take longer to see progress in paying off your debts. By focusing on the debt with the highest interest rate, it may take longer to pay off your first debt compared to other methods. Additionally, the focus on the highest interest debt can lead to feelings of frustration, especially if smaller debts are not addressed as quickly. This strategy may not be the most effective for everyone, as those with a large amount of high-interest debt may find it more cost-effective to focus on paying that off first.
Know what could really help you sort through these important issues?
What?
Orange Mocha Frappuccino! Yeah! Yeah!
Another drawback of the avalanche method is that it may not address the underlying financial issues that led to the debt in the first place. It also may not work well for individuals who need motivation and a sense of progress to stick to a debt repayment plan. Ultimately, neither the snowball method nor the avalanche method addresses the root cause of the debt. It is important to address and resolve these underlying issues in order to prevent future financial difficulties.
A credit card is a payment card that allows you to borrow money from a bank or financial institution up to a certain limit, which you can then use to make purchases or withdraw cash. You typically need to repay the borrowed amount, along with interest and any fees, within a specified time frame. Some credit cards offer rewards or other benefits for using the card, such as cashback or travel points. Whether travel points are financially worth it depends on your individual spending habits and travel goals. For some people, the rewards and benefits they receive from using a travel rewards credit card can offset the costs and fees associated with the card, making it a valuable tool for saving money on travel expenses. However, for others, the costs and fees may outweigh the benefits, making a travel rewards card less advantageous. It's important to consider factors such as the annual fee, interest rate, and redemption options when evaluating the financial worth of a travel rewards card. Additionally, you should compare the rewards and benefits offered by different cards to find one that best aligns with your spending habits and travel goals. It's also a good idea to regularly review your credit card statements to track your spending and ensure you're using the card in a way that is financially beneficial for you. A debit card is a payment card linked to your checking account. It allows you to access the funds in your account to make purchases or withdraw cash from ATMs. Unlike a credit card, a debit card does not allow you to borrow money. Instead, it directly accesses the funds you have in your account. When you use a debit card, the transaction is immediately deducted from your account balance. Debit cards are generally considered a convenient and secure alternative to cash and checks, and they can also offer some of the same benefits as credit cards, such as rewards and discounts. The better choice between debit cards and credit cards depends on your individual spending habits and financial goals. Debit cards are a good choice if you want to avoid debt and only spend money you already have. They provide a convenient and secure way to access your checking account and make purchases or withdraw cash. Debit cards are also typically less expensive than credit cards, with lower fees and interest rates. Credit cards, on the other hand, offer the ability to earn rewards, making them a good choice for people who are able to pay their balances in full each month. Ultimately, the best choice for you will depend on your individual spending habits and financial goals, as well as the costs and fees associated with each type of card. It's important to carefully consider all the factors and choose the option that works best for you. Pay later businesses are companies that offer consumers the ability to purchase goods or services and defer payment until a later date. They typically provide this service through a financing arrangement, allowing consumers to pay for their purchases in installments or as a lump sum at a later date. Examples of pay later businesses include buy now, pay later, BNPL companies such as Afterpay, Klarna, and Affirm, which offer consumers the ability to make purchases without having to pay for them up front. Instead, they allow customers to pay for their purchases in smaller, more manageable installments over a set period of time.
Toss a coin to your witcher, oh valley of plenty, oh valley of plenty, oh.
Pay later businesses often target younger, digitally savvy consumers who are looking for more flexible and convenient payment options. They also provide an alternative to traditional credit options, such as credit cards, personal loans, or post-dated checks, and can help consumers build or improve their credit history. However, it's important to note that pay later businesses typically charge fees and interest on the deferred payments, and some may also perform credit checks to determine a customer's eligibility for their services. As with any form of credit, it's important to carefully consider the costs and terms before using a pay-later business and to use this service responsibly. Building a good credit history is crucial for establishing financial stability and obtaining loans or credit in the future. A positive credit history is created by borrowing and repaying debt responsibly. Here are some steps you can follow to build good credit. Getting a credit card is an easy and convenient way to start building a credit history.
Wow, my own credit card!
When choosing a credit card, it is important to pick one with favorable terms, such as a low interest rate and annual fee. It is also crucial to use the credit card responsibly and avoid overspending. Making on-time payments is essential for building a good credit history. Late payments can have a significant negative impact on your credit score. Therefore, it is important to make all payments on time, every time, to maintain a positive credit history. Keeping your credit card balances low is also important for maintaining a good credit score. High credit card balances can lower your credit score, so it is best to keep balances low and pay off as much debt as possible each month. Opening too many credit accounts at once can indicate financial instability and lower your credit score. It is best to limit the number of credit accounts you open and space out new applications. Monitoring your credit regularly is also important for maintaining a good credit history. Checking your credit report can help you identify and resolve errors or fraudulent activity and ensure that your credit history is accurate and up to date.
You can't have a conscience and be a con man as well,
No,
can
you
you?
can't have a conscience and be a con man. And you know, you can only change if you want to change. You have to be willing to want to do that. And you can't expect someone else to do it for you. You have to do it, and it's not easy. You got to change your life.
Applying for too much credit too soon can also have a negative impact on your credit score. Each credit application shows up on your credit report and can lower your credit score. It is best to limit the number of credit applications you make and avoid applying for too much credit within a short period of time. Finally, keeping old credit accounts open is also important for building a good credit history. The length of your credit history is a crucial factor in determining your credit score, so it is best to keep old credit accounts open, even if you are not using them. Building a good credit history is not limited to having a credit card. There are several alternatives to consider if you want to build a positive credit history without a credit card. One alternative is to repay an installment loan such as a personal loan, auto loan, or student loan. Making on-time and full payments on these loans can help build a positive credit history.
What is it, Fry?
You want some lemonade? You saw a big parade?
Your student loans have been repaid? Then how about lending your old pal Zoidberg a few bucks, Mr. Millionaire?
Another alternative is paying your rent. Some landlords may report your rent payments to credit bureaus, so paying your rent on time and in full can help build a positive credit history. Paying for utility bills, such as electricity, gas, and water on time, can also help build a positive credit history. By making on-time payments for these bills, you are demonstrating your financial responsibility and stability. A secured credit card is another option to consider. A secured credit card requires a security deposit, which acts as collateral for the credit line. You can use a secured credit card like a regular credit card, and your payments will be reported to credit bureaus, helping you build a positive credit history. Finally, obtaining a loan from a credit union or community organization can also help build a positive credit history. Some credit unions and community organizations offer small loans to help members build their credit. Repaying these loans on time and in full can help establish a positive credit history. A good credit history is an important factor in many financial decisions. It is used by lenders, banks, and other financial institutions to evaluate your creditworthiness and determine your ability to repay a loan or credit card balance. Having a good credit history can increase your chances of being approved for loans, such as a mortgage, auto loan, or personal loan. It may also result in more favorable terms and lower interest rates, making it easier for you to access credit and achieve your financial goals. Landlords may also check your credit history when you apply for a rental property. A good credit history can demonstrate that you are a responsible tenant and able to pay rent on time.
Ventura.
Yes, Satan? Oh, I'm sorry, sir. You sounded like someone else.
Never mind the wisecracks, Ventura. You owe me rent.
Mr. Chickadance, I told you, you're my first priority.
Some employers may also check your credit history when you apply for a job, especially for jobs that involve handling money or sensitive financial information. By maintaining a good credit history, you can demonstrate your financial stability and responsibility to potential employers. Insurance companies may use your credit history to evaluate your risk and set your premiums. Service providers, such as electric, gas, and water companies, may also check your credit history to determine if you are a reliable customer and able to pay your bills on time. In conclusion, by maintaining a good credit history, you can demonstrate financial responsibility and increase your chances of being approved for loans, credit cards, and other financial products, and enjoy more favorable terms and lower interest rates.
Living within your means is a crucial aspect of managing your finances effectively. It means ensuring that your expenses do not surpass your income, allowing you to live a comfortable life without accumulating debt. To achieve this, there are several tips that you can follow. The first step is to create a budget. This involves listing down all of your sources of income and expenses, including rent, mortgage, utilities, food, transportation, entertainment, and debt payments. This will give you a clear understanding of your financial situation and allow you to make informed decisions about your spending.
What the hell is that?
An alpaca, I got the last one.
It is also important to track your spending for a few weeks to see where your money is going. This will help you identify areas where you can reduce your expenses and prioritize your spending. Decide which expenses are essential and which are discretionary, and focus on cutting back on the latter. Regular saving is also crucial in living within your means. Put aside a portion of your income into savings each month to build an emergency fund and prepare for unexpected expenses. At the same time, it is important to avoid taking on new debt, such as credit card balances and loans, unless it is absolutely necessary. In addition, you can save money on everyday purchases by shopping smart, such as looking for sales, comparing prices, and opting for generic or store-brand products instead of name brands. Evaluate your monthly expenses and identify areas where you can cut costs, such as cable and internet bills, gym memberships, and subscriptions. It is also essential to be mindful of your habits and make changes to avoid overspending and impulse buying. Automating your savings by setting up automatic transfers from your checking to your savings account each month can help ensure that you consistently put money aside. Finally, be mindful of lifestyle inflation, which is the tendency to increase your expenses as your income grows. Make sure to save or invest any extra income instead of using it to upgrade your lifestyle. In conclusion, living within your means is essential for financial stability and success. By following these tips and being mindful of your spending and income, you can avoid financial stress and achieve your financial goals. The money bucket technique is a method of organizing personal finance and prioritizing spending based on set goals and financial priorities. It involves dividing your money into several buckets or categories, such as savings, daily expenses, and debt repayment, to ensure that you are allocating your funds in a way that aligns with your financial goals and priorities. This may mean separating your savings into different accounts under the umbrella of one bank or into different banks entirely. Neither technique, in and of itself, is preferred over the other, and simply relies upon your self-control and ease of access required for the funds. Pay yourself first is a financial strategy that involves putting aside a portion of your income for savings and investment before paying any other bills or expenses. This means that before spending money on other things, you prioritize your own financial well-being by saving and investing in your future. By doing this, you are creating a habit of consistently putting aside money for your financial goals and making it a priority, rather than just saving what is left over after paying other bills. This approach prioritizes savings and encourages you to make responsible spending decisions. Additionally, putting aside money for your future supports long-term planning and helps you to prepare for emergencies or unexpected expenses. By consistently saving and investing over time, you can build wealth and achieve financial security. The 50-20-30 budget is a personal finance strategy that helps individuals to manage their finances by dividing their income into 3 categories. 50% of the income is allocated towards necessities such as housing, food, transportation, insurance, and other essential expenses. This ensures that the basic needs are covered and helps in avoiding overspending on non-essential items. 20% of the income is put towards savings, debt repayment, and investing for the future. This helps to build wealth and increase financial security over time. The focus on savings and debt repayment can help individuals to reduce their financial burden and increase their overall financial stability. 30% of the income is reserved for personal spending. This can be used for hobbies, entertainment, and travel, among other things. This helps individuals to have some flexibility in their spending and enjoy their hard-earned money. In conclusion, the 50-20-30 budget provides a simple and flexible framework for managing personal finances. By keeping necessary expenses to 50% or less, individuals can reduce the risk of overspending and improve their financial stability, while ensuring that enough money is put towards savings, debt repayment, and discretionary spending. Zero-based budgeting is a method of personal finance management where your income minus expenses equals 0. In other words, every dollar of your income is allocated to a specific purpose, whether it be for expenses, savings, or debt repayment. The goal of zero-based budgeting is to ensure that every dollar is accounted for and that you are spending within your means. This budgeting method involves creating a monthly budget from scratch, taking into account all of your income and expenses, and making adjustments as necessary to ensure that your spending aligns with your priorities and financial goals. By considering all of your income and expenses, you can better understand your spending habits and identify areas where you can make changes to improve your financial situation. This can help you to make informed decisions about how you want to manage your money and set realistic goals for your financial future. In addition, zero-based budgeting promotes spending within your means. By allocating every dollar of your income to a specific purpose, you are less likely to overspend and more likely to stick to your budget. This can help you to maintain better control over your finances and make sure that you are living within your means. Another advantage of zero-based budgeting is that it supports long-term planning. By accounting for all of your expenses and prioritizing your financial goals, you can better plan for the future and reach your financial objectives.
Woo! Way to go, boss! That's north wind, sucker!
Nicely done.
Blah, 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 blah. Good plan is about more than effecty stuff and vocabulary words.
This can help you to build a solid financial foundation and achieve greater financial stability over time. Finally, zero-based budgeting can help to improve your cash flow. By reducing unnecessary expenses and making sure that every dollar is accounted for, you can increase your financial stability and reduce your risk of financial problems. However, there are also some disadvantages to zero-based budgeting. One of the biggest challenges is that creating a zero-based budget can be time-consuming, especially if you have many expenses to track and categorize. Additionally, zero-based budgeting requires discipline and consistency, as you need to stick to your budget and make changes as necessary to ensure that your spending aligns with your priorities and financial goals. In some cases, zero-based budgeting can also be rigid and inflexible, and may not allow for unexpected expenses or changes in circumstances. Additionally, depending on your budget, zero-based budgeting may leave little room for leisure or discretionary spending, which can be stressful or make it difficult to stick to the budget in the long run. Ultimately, the best approach to budgeting depends on your individual financial situation, goals, and priorities. You may find that a combination of strategies works best for you, and it's important to find a method that you feel comfortable using and that helps you to achieve your financial goals. Emergency funds, the bare bones of the saving world. The one thing all these saving techniques recommend is an emergency fund separate from your main everyday account. The amount required, though, for an emergency fund varies depending on an individual's personal financial situation, expenses, and level of financial security.
Money, money, this money, money, that profit will make me wallet fat. What? Profit's down $3 from last month. I gotta start running a tighter ship around here.
A commonly recommended amount is to have at least 3 to 6 months of living expenses saved in a readily accessible account, such as a savings account. However, some financial experts recommend having even more in emergency savings, especially if you have a high level of debt or other financial obligations. Ultimately, the goal of an emergency fund is to provide a safety net for unexpected expenses, so the amount should be sufficient to cover those needs and give you peace of mind.
Investing refers to the act of allocating money into financial assets with the expectation of earning income or capital appreciation. This can include stocks, bonds, mutual funds, real estate, commodities, and other investment vehicles. The goal of investing is to grow wealth over time through strategic decisions based on an understanding of market conditions and investment principles. Compound interest is the interest earned on the initial principal, and also on the accumulated interest of previous periods. In other words, the interest earned in one period is added to the principal, and the next period's interest is calculated based on the new higher principal balance. This creates a snowball effect, where the interest earned in each subsequent period grows larger and larger, leading to compound growth of the principal. A simple example of compound interest. Suppose you have $100 and want to invest it in a bank that pays a 5% interest rate annually. In the first year, the investment grows to $105, which is calculated by adding 5% to the original amount of $100. The second year, the interest earned on the new total of $105 is calculated at 5% again, growing the investment to $110.25. By the end of the third year, the interest earned on $110.25 is calculated at 5% once more, bringing the total to $115.76. This pattern of interest being added to the original amount each year creates a snowball effect that leads to compound growth of the investment. This can be particularly beneficial for long-term investments, such as retirement savings, as the compounding effect has more time to take hold. To take advantage of this powerful tool, it's important to start investing early, even with small amounts, and contribute regularly over time. However, it's crucial to consider your financial goals and risk tolerance when choosing investment options. Investing regularly and early is a great start, but selecting the right options for you can help ensure that your investments are working towards your financial goals. High-yield savings accounts are bank accounts that offer higher interest rates compared to traditional savings accounts.
It's gonna go. It's gonna go!
This type of account typically pays a higher annual percentage yield, APY, which is the rate of interest that is earned on the balance in the account. The interest earned in a high-yield savings account is usually higher because the bank is able to offer a higher rate due to its online-only business model or other factors. The interest rate offered on savings accounts is impacted by a variety of factors, including Federal Reserve policy, economic conditions, competition among banks and credit unions, bank costs, and inflation. The Federal Reserve sets the federal funds rate, which influences the interest rates offered on savings accounts. Economic conditions also play a role in determining interest rates. During periods of economic growth, interest rates tend to be higher, while in times of uncertainty, they they may be lower as a way to stimulate borrowing and investment. Competition among banks and credit unions for customers can also impact interest rates on savings accounts. In a low interest rate environment, banks may offer lower rates to remain competitive. Additionally, banks have to cover their operating costs and make a profit, so they may offer lower interest rates on savings accounts to ensure their profitability. Inflation is another factor that can impact interest rates, as it reduces the purchasing power of money and may prompt banks to offer lower rates on savings accounts. While low interest rates on savings accounts can be disappointing, it's important to remember that savings accounts are still a safe and convenient place to store your money and earn a small return. If you're seeking higher returns, you may consider alternative investment options such as stocks, bonds, or mutual funds. It's important to carefully consider your financial goals and risk tolerance before making any investment decisions. A credit default swap, CDS, is a type of financial derivative contract that provides insurance against the risk of default by a borrower, such as a corporation or government. The buyer of the CDS pays a periodic premium to the seller in exchange for a payout if the borrower defaults on its debt obligations. In other words, the CDS acts as a form of insurance for the holder of the debt, the buyer of the CDS, transferring the credit risk from the debt holder to the seller of the CDS. The buyer of the CDS may not have owned the underlying debt but is seeking protection against the risk of default, while the seller of the CDS is accepting the credit risk in exchange for the premium income. CDS have been used in various forms of speculative and hedging activities and have been criticized for contributing to the financial crisis of 2008. Retirement plans are an essential aspect of financial planning that helps individuals prepare for their future. These plans are designed to provide a stable source of income during retirement when the individual may no longer be earning a regular salary.
Boys, I'm retiring. From what? From the grind. I mean, who needs it? I've accomplished everything I've set out to do.
There are several types of retirement plans that are available, each with its unique features and benefits. Defined benefit plans, also known as pensions, are plans that provide a specified monthly benefit at retirement, based on factors such as the employee's earnings history, years of service, and age. These plans are commonly found in countries like the UK, Canada, and Australia. Defined contribution plans, on the other hand, are plans where the employee and/or employer contribute a specified amount to an individual account, and the benefit at retirement is based on the balance in the account and investment returns. Examples of such plans include 401k plans in the U.S. and Group Retirement Savings Plans, GRSP, in Canada. Statutory pension schemes, provident funds, and superannuation are mandatory retirement savings plans that are sponsored by the government or the employer in countries like Japan, India, and Australia, respectively. National pension systems are government-run pension plans that are available in countries like South Korea, while individual retirement accounts, IRAs, are plans established by individuals to save for retirement, often with tax advantages. Annuities and life insurance policies with a savings component are other options for retirement planning. Annuities are contracts with insurance companies that provide a guaranteed stream of income in exchange for a lump sum payment, while life insurance policies with a savings component provide both protection and savings for retirement. Putting your own money into a retirement plan can be a smart financial decision. There are several benefits to these types of plans that can help you build a secure financial future for your retirement years. One major benefit is the tax advantages offered by certain types of retirement plans. Contributions to these plans may be tax-deductible or may grow tax-free until you withdraw the funds. Additionally, many employers offer a matching contribution to employee contributions, which is effectively free money towards your retirement. Another benefit of retirement plans is the compound interest that your contributions can earn over time. With investment returns, your contributions can grow significantly over the long term, resulting in substantial savings.
Extraordinary.
Furthermore, by automatically deducting contributions from your paycheck, retirement plans can help you save consistently and avoid the temptation to spend the money on other things. While investing in a retirement plan can be a wise choice, it's important to consider your individual financial situation and goals, when deciding how much to contribute. The earlier you start contributing to a retirement plan, the more time your money has to grow, so starting early is a key factor in building a solid retirement plan.
The stock market, also known as the share market, is a marketplace where publicly traded company stocks and other securities are bought and sold. It is a platform where individuals and organizations can invest their money in the hopes of earning a return on their investment through capital appreciation or dividends. The performance of the stock market is often used as a barometer for the overall health of an economy, although in reality the two are not tied together and often butt heads due to different driving forces behind each one. When you own a stock, you own a piece of the company and have a claim, albeit usually small, on part of its assets and earnings. For example, if you bought just one stock of Apple in 2021, you'd own approximately 0.00000023% of the total 4.3 billion outstanding Apple stocks on the NASDAQ. Stocks are issued and bought through stock exchanges, also known as a share market, and their price can rise or fall based on various factors such as the company's financial performance, market conditions, and investor sentiment. Stockholders are entitled to vote on certain corporate matters and may receive dividends, which are payments to shareholders made by the company out of its profits.
If you vote for me, all of your wildest dreams will come true.
Investing in stocks can be a great way to grow your wealth over time. To purchase stocks, you will need to work with a brokerage firm that performs as an intermediary between buyers and sellers of stocks and other securities. There are different types of brokerages, including online discount brokers and traditional full-service brokerages. Some popular online discount brokers include TD Ameritrade, E-Trade, and Robinhood, while traditional full-service brokerages include Morgan Stanley and Merrill Lynch. In addition, many local banks such as J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, Deutsche Bank, Barclays, and Paribas in Europe. Mitsubishi, Financial Group, China Construction Bank, Industrial and Commercial Bank of China, Mitsui Sumitomo Banking Corporation in Asia. Commonwealth Bank of Australia, Westpac Banking Corporation, and Bank of New Zealand offer brokerage accounts. To get started, you'll need to open an account with a brokerage firm and then deposit funds into the account. Once the funds are available, you can place an order to buy the stocks you're interested in. The brokerage will execute the trade on your behalf, and the stock will be held in your brokerage account. By owning a piece of a company through its stock, you become a shareholder with a claim on part of its assets and earnings. The price of a stock can rise or fall based on various factors such as the company's financial performance, market conditions, and investor sentiment. Advanced markets, developing markets, and emerging markets are commonly used terms to describe different stages of economic growth and development, as well as to categorize countries based on their financial markets. Advanced markets are typically countries that have established, mature financial markets with a deep regulatory framework, extensive and liquid capital markets, and a large number of publicly traded companies. Examples of these countries include the United States, Japan, and Western Europe. Developing markets, on the other hand, are countries that have growing financial markets but have not yet reached the level of sophistication found in advanced markets. These countries may have less developed regulatory frameworks, smaller capital markets, and fewer publicly traded companies, but they can offer higher growth and investment opportunities. Examples of developing markets include India, China, Brazil, Russia, and South Africa. Emerging markets are countries with rapidly growing and developing financial markets, and that are transitioning from developing to advanced markets. These countries may have expanding capital markets, growing numbers of publicly traded companies, and increasing investment opportunities, but they may also be subject to higher levels of volatility and risk. Examples of emerging markets include Vietnam, Cambodia, Uzbekistan, and many other countries in Central Asia, Africa, and South America. It's worth noting that these terms are generalizations, and there can be overlap between categories. The specific financial market status of a country can also change over time as countries move through different stages of development. Capital appreciation and dividends are two ways that stocks can provide a return on investment.
Brothels make a much better investment than ships, I've found. Holes rarely sink.
Capital appreciation refers to an increase in the value of a stock over time, which can be realized when the stock is sold for a higher price than the purchase price. Capital appreciation occurs when the market values the stock higher based on factors such as the company's financial performance, market conditions, and investor sentiment. Dividends, on the other hand, are payments made by a company to its shareholders out of its profits. Dividends provide a regular income stream for stockholders and can provide a more stable return on investment. However, not all companies pay dividends, and the amount of dividends a company pays can fluctuate over time based on the company's financial performance. Both capital appreciation and dividends can provide a return on investment, and the combination of the two can help to provide a more balanced and potentially more stable return. When considering investing in stocks, it's important to research the company and its financial performance, as well as the overall market conditions, in order to determine the potential for capital appreciation and dividends. To receive stock dividends, you need to own the stock on the record date, which is the date set by the company to determine which shareholders are eligible to receive the dividend. On the payment date, the company will distribute the dividend to eligible shareholders.
I cannot believe you.
Rose, listen to me. I can explain.
You are making $500,000 and you were only going to pay me 30?
You're getting 30 grand? I'm getting 1,000.
But you guys are getting paid?
To receive dividends, you must hold the stock in your brokerage account or directly with the company, depending on the company's dividend payment policy. If you hold the stock in a brokerage account, the brokerage will typically automatically deposit the dividend into your account, or you may be able to choose to reinvest the dividends in additional shares of the stock. It's important to note that not all companies pay dividends, and some companies may change the amount or frequency of their dividends over time. Before investing in a stock, it's recommended to research the company and its dividend history to understand the potential for receiving dividends and to factor this into your investment decision. Reinvesting dividends is a smart strategy for stock investors who want to maximize their returns and grow their portfolio over time. The process involves using the dividends received from a stock to purchase additional shares of the same stock, thereby increasing the investor's ownership of the company. The benefits of reinvesting dividends are many, including compound growth, increased ownership, diversification, and in some cases, tax benefits. One of the key benefits of reinvesting dividends is the compound growth it can provide. By reinvesting the dividends received, the portfolio can grow faster, as the reinvested dividends generate additional dividends, which can then be reinvested again. This creates a cycle of compound growth that can potentially lead to higher returns over time. Another benefit of reinvesting dividends is increased ownership. As the investor gradually reinvests their dividends, they can gradually increase their ownership of the stock. This can help the investor benefit from the potential appreciation of the stock over time, which can lead to higher overall returns. Reinvesting dividends can also help to diversify an investor's portfolio. By using the dividends to purchase additional shares of the same stock, the investor is able to maintain a strong position in a stock that they believe in, rather than using the dividends for other purposes. This can help to spread the investor's risk and reduce the impact of any downturns in the stock market. Finally, reinvesting dividends can also have tax benefits, as the reinvested dividends may be eligible for a lower tax rate than if the dividends were taken as cash. This can help to reduce the overall tax burden for the investor, freeing up more capital for reinvestment and further growth.
Now to the top of Mount Springfield for the coronation. Remove the stone of shame. Woohoo! Attach the stone of triumph. Oh!
The stock market can be both a short-term and a long-term investment, depending on an individual's investment goals and risk tolerance. For some investors, the stock market is a short-term investment, where they buy and sell stocks within a few months or even a few days to take advantage of market fluctuations and generate quick profits. This strategy requires a high level of market knowledge, risk tolerance, and market timing skills. For others, the stock market is a long-term investment, where they buy and hold stocks over several years or even decades, with the goal of building wealth over time through capital appreciation and/or dividends. This strategy typically involves a more diversified portfolio and a lower level of market timing, but also requires patience and discipline. Ultimately, the length of time that an investor holds onto stocks will depend on their investment goals, risk tolerance, and overall financial situation. Some investors may choose to adopt a combination of short-term and long-term strategies, depending on their goals and market conditions. Investing in the stock market can be a great way to grow your wealth over time, but there are many different investment strategies to choose from. Each strategy has its own set of goals, risks, and benefits, so it's important to choose the one that best fits your financial situation and investment goals. One popular strategy is dividend investing, which involves investing in stocks that pay dividends. The goal of this strategy is to generate steady income from the dividends received, which can help to provide a source of passive income over time. Another strategy is value investing, which involves investing in stocks that are undervalued and have the potential to increase in value over time. Value investors look for companies that have strong financials, competitive advantages, and a history of steady growth. And they believe that these companies will eventually be recognized by the market and their stock price will increase. For those who are looking for higher potential returns, growth investing may be a good option. This strategy involves investing in companies that are growing rapidly and have the potential for high capital appreciation. Growth investors focus on companies with high revenue growth, large market opportunities, and innovative products or services. Index investing is a strategy that involves investing in a stock market index, such as the S&P 500, with the goal of matching the overall performance of the market. This is often seen as a low-cost, low-risk investment strategy, as the investor is not trying to pick individual stocks, but instead is simply investing in the overall market. Momentum investing is a strategy that involves investing in stocks that have been performing well in the recent past, with the expectation that they will continue to perform well in the future. This strategy is based on the idea that stocks that are already performing well are more likely to continue to do so in the future. Finally, dollar-cost averaging is a strategy that involves investing a fixed amount of money into the stock market at regular intervals, regardless of the market conditions. This can help to reduce the impact of market volatility and minimize the risk of market timing, as the investor is investing the same amount of money into the market each time, regardless of whether the market is up or down. In conclusion, it's important to remember that past performance is not indicative of future results, and that no investment strategy can guarantee returns. An investor's choice of strategy should be based on their individual financial situation and investment goals, and should be accompanied by a comprehensive understanding of the market and the risks involved. There is no universally agreed upon best investment strategy for the stock market. The best strategy for you depends on your financial goals, risk tolerance, and individual circumstances. That being said, a common approach among long-term investors is to create a well-diversified portfolio that is designed to meet their specific investment goals. This typically involves investing in a mix of large, stable blue-chip stocks, value stocks, growth stocks, and/or index funds. It is also important to regularly review and adjust your investment portfolio as needed to ensure that it continues to align with your financial goals and risk tolerance. It's important to remember that no investment strategy can guarantee returns, and that all investments carry a certain degree of risk. It's always best to do thorough research and consult with a financial professional before making any investment decisions. Exchange-traded funds, ETFs, are investment products that can be bought and sold on stock exchanges just like individual stocks. They are a collection of assets, such as stocks, bonds, commodities, or other securities, and aim to mirror the performance of a particular market index or sector. The key advantage of ETFs is that they provide diversification by offering exposure to a broad range of assets, reducing the risk associated with investing in a single stock or market sector. ETFs are also highly liquid, making it easy for investors to buy and sell them throughout the trading day. Additionally, ETFs tend to have lower fees and expenses compared to mutual funds, making them a cost-effective investment option. Furthermore, the structure of ETFs helps minimize capital gains taxes, making them a tax-efficient investment choice. Lastly, ETFs can be easily bought and sold like stocks, allowing investors to adjust their portfolios to changing market conditions. It is important to keep in mind that, like all investments, ETFs carry risks, and it's crucial for investors to thoroughly understand the underlying assets and market conditions before making an investment decision. Blue-chip stocks are shares of well-established and financially stable companies that have a history of steady growth, high dividends, and a strong brand reputation. Blue-chip stocks are typically considered to be a safer investment option compared to more speculative or high-risk stocks, and are often a cornerstone of long-term investment portfolios. Investing in blue-chip stocks can provide investors with a steady stream of dividends, as well as the potential for long-term capital appreciation. However, blue-chip stocks are typically considered to be a more conservative investment and may not offer the same level of potential returns as more speculative or high-growth stocks.
If you invest your tuppence wisely in the bank, safe and sound.
Value stocks are stocks that are considered to be undervalued by the market. Value investors look for companies with strong fundamentals, such as low price-to-earnings ratios and high dividend yields, with the expectation that the market will eventually recognize their value and the stock price will increase. The idea behind value investing is to purchase stocks that are trading at a discount to their intrinsic value. Value investors believe that these stocks are undervalued by the market, and that the market will eventually recognize their true worth, leading to a stock price increase. Value stocks can be found in a variety of industries, including financials, energy, and consumer staples. Blue-chip stocks and value stocks are different types of investments, although there can be some overlap between the two. Growth stocks are stocks in companies that are expected to grow at a faster rate than the overall market. These companies typically reinvest their earnings back into their business in order to drive future growth, rather than paying out dividends to shareholders. Growth stocks are often associated with young, innovative companies in high-growth industries such as technology, biotechnology, and e-commerce. Investors in growth stocks are typically looking for capital appreciation, as the stock price is expected to increase as the company grows and becomes more valuable. However, growth stocks can also be riskier than other types of stocks, as they often have higher price-to-earnings ratios and are more sensitive to market changes and economic conditions. They can also be more volatile than other types of stocks, as their stock prices can fluctuate rapidly based on market sentiment and perceived growth potential. Penny stocks are stocks that trade for less than $5 per share. They are typically issued by small, speculative companies with limited financial resources, operating histories, or revenue streams. Investing in penny stocks can be risky, as these companies often face numerous challenges, including limited financial resources, competition from larger established companies, and a higher likelihood of business failure. In addition, penny stocks can be subject to market manipulation, which would artificially inflate their prices and increase the risk of financial losses for investors. However, penny stocks can also offer the potential for high returns, as these companies can experience rapid growth and significant increases in stock price if their businesses succeed. Investors considering penny stocks should be aware of the potential risks and carefully research the companies they are considering investing in. They should also have a strong understanding of the market, as well as a high level of risk tolerance and a long-term investment horizon.
The housing market refers to the buying and selling of houses and other real estate properties. It is influenced by various factors such as economic conditions, interest rates, supply and demand, and government policies. The performance of the housing market can have significant effects on the overall economy, and unlike the stock market, can actually be used as an indicator of economic growth or decline. Renting a house can provide more flexibility and a lower upfront cost, as renters do not have to come up with a large down payment or pay for maintenance and repairs. Renting also allows for a more predictable monthly expense, as rent does not usually change significantly over time. On the other hand, buying a house can provide long-term financial benefits, as homeowners can build equity over time through mortgage payments and property values tend to appreciate over time. Owning a house also provides a sense of stability and can be more desirable for those who want to put down roots and stay in one place for an extended period of time. It's important to consider factors such as your personal financial situation, lifestyle, and long-term plans when deciding whether to rent or buy a house. You should also consider factors such as the cost of homeownership, the length of time you plan to stay in the house, and your willingness to take on the responsibilities that come with homeownership. When considering purchasing an owner-occupied home, it's essential to ask the right questions to make an informed decision. There are several key aspects to consider, from the area's crime rate to the local school district, and property taxes to utility costs. Understanding the local market trends and any planned developments or changes in the area can also be important. One of the most important questions to ask is about the area's crime rate. You want to ensure that you and your family will be safe in your new home. Environmental hazards, such as flooding or air pollution, are also important to consider. The local school district is another critical aspect to think about, especially if you have children. Understanding the current market trend in the area will give you an idea of the property's value and what to expect in terms of future growth. Another important aspect to consider is the property tax rate and any associated monthly expenses, including utilities. You'll want to make sure you're aware of any restrictions on the property, such as zoning regulations or rules set by the homeowners association. The condition of the home and any associated repair or renovation costs are also important to keep in mind. Finally, it's a good idea to ask the seller about their motivation for selling the property. In conclusion, asking the right questions when purchasing an owner-occupied home is critical to making an informed decision. An experienced real estate agent can be a valuable resource in this process, helping you navigate the many important aspects to consider when buying a home.
Welcome to the big leagues, Marge. There's over 50 years of real estate experience right in this room, and 42 of those years are Gil's.
Marge, it's a real pleasure. You got any leads? I need some leads, please. Help me.
That's enough, Gil. Don't drag her down with you.
A buyer's agent and a vendor's agent are two different types of real estate agents who represent either the buyer or the seller in a real estate transaction. A buyer's agent represents the buyer and works to find the best property for their client, negotiate the best price and terms, and guide them through the buying process. A buyer's agent owes a fiduciary duty to their client and is responsible for representing their best interests. On the other hand, a vendor's agent represents the seller and works to market and sell the property, negotiate with potential buyers, and assist with the sales process. A vendor's agent owes a fiduciary duty to the seller and is responsible for representing their best interests.
He didn't fall!
Fiduciary.
You keep using the word. I don't think it means what you think it means.
It's important to understand the role of each type of agent in a real estate transaction and choose the right agent to represent you, whether you're buying or selling a property. Buying a standalone house or an apartment can both have financial benefits, depending on your individual circumstances and goals. Owning a standalone house can provide long-term financial benefits, as property values tend to appreciate over time and can provide a source of passive income through rental income if the house is rented out. Owning a house also allows for building equity through mortgage payments. On the other hand, buying an apartment can be more affordable upfront, as apartments typically cost less to purchase than standalone houses. In addition, apartments may have lower monthly expenses, such as maintenance, property taxes, and insurance, which are often shared among residents.
We'd like to invite you to no longer live with us anymore.
What? What do you mean? I don't get it.
Well, the thing is,
we decided that it was actually a bit immature for a grown-up brother and sister to still be living together with a roommate.
Yeah.
At our age. Bit ridiculous,
What?
isn't it?
Yeah.
We look a bit silly, don't
Pathetic.
we? Yeah.
What?
So we're actually going to live together alone without you.
You're moving out.
A fixed-rate mortgage is a type of home loan where the interest rate remains the same over the entire term of the loan, or an agreed-upon length of time such as 2, 3, or 5 years. This means that the monthly mortgage payment will not change, regardless of changes in the interest rate environment. With a fixed-rate mortgage, the borrower can plan their monthly budget with more certainty and stability, as the monthly payment remains constant over the life of the loan. Fixed-rate mortgages are a popular option for many homebuyers because they offer the security of a predictable monthly payment. A variable rate mortgage, also known as an adjustable rate mortgage, ARM, is a type of home loan where the interest rate can change over time. This means that the monthly mortgage payment can increase or decrease based on changes in the interest rate environment. Variable rate mortgages typically have a lower initial interest rate than a fixed rate mortgage, which can make them a more affordable option for some borrowers. However, the interest rate on a variable rate mortgage can increase over time, which can result in higher monthly payments. As the name may suggest, a split home loan is a type of mortgage where a portion of the loan is fixed at a set interest rate and another portion is variable. Split home loans offer the benefits of both fixed rate and variable rate mortgages. The fixed rate portion provides stability and certainty as the monthly payment remains constant for the life of the fixed rate term. The variable rate portion can provide some flexibility as the monthly payment may change based on changes from the central bank. Split home loans can be a good option for borrowers who want to take advantage of the lower initial interest rate of a variable rate mortgage, but also want some stability and certainty. By splitting the loan, borrowers can potentially lower their monthly payment while still enjoying the security of a fixed rate mortgage. An interest-only loan is a type of mortgage where the borrower only pays the interest on the loan for a specified period of time, typically 5 to 10 years. During the interest-only period, the loan balance does not decrease, and the borrower does not build any equity in the property. After the interest-only period, the loan typically converts to a traditional mortgage, where the borrower must start making payments on both the interest and the principal. The monthly payment may increase significantly at this time, as the borrower must start paying down the loan balance. Interest-only loans can be a good option for borrowers who expect their income to increase significantly in the future, or for those who want to keep their monthly payments low for a specific period of time. However, it is important to consider the long-term financial impact of an interest-only loan, as the loan balance will not decrease during the interest-only period, and the monthly payment may increase significantly after the interest-only period ends. It is important to carefully consider your personal financial situation, long-term plans, and risk tolerance when deciding whether an interest-only loan is the right choice for you. You should also consult with a financial advisor or a mortgage lender to help you determine the best type of mortgage for your individual circumstances. Housing is often considered a form of investment, as property values can appreciate over time and provide a source of passive income through rental income. Investing in the housing market can be a good way to build wealth over the long term. However, it is also important to consider the risks involved, such as fluctuations in property values and changes in the real estate market. When looking for an investment property in an unfamiliar area, it is crucial to gather as much information as possible to make an informed decision. Location is a key factor when evaluating an investment property. Questions to consider include the neighborhood's proximity to amenities, public transportation, and employment centers, as well as whether the area is desirable for renters. Rentability is also important, and you should consider the average rental rate for similar properties in the area. The property's condition is another key factor, and you should ask about any major repairs or renovations that may be needed. Maintenance costs, including property management, insurance, taxes, and repairs, should also be taken into account.
I realize some people may find the ins and outs of tax law a little tedious, so allow me to spice this story up. Instead of an audit, imagine this is a showdown between two warriors in the most brutal and exciting form of combat there is: chess.
Additionally, it is important to consider any future developments in the area that could impact the value of the property, including rental income, appreciation, and tax benefits. An experienced real estate agent can also be a valuable resource in this process, providing valuable insight and expertise to help you make the best investment decision possible.
Alternative investments refer to investment assets that are not considered traditional investments, such as stocks, bonds, and cash. Alternative investments include a wide range of assets, such as real estate, commodities, hedge funds, private equity, and collectibles. The idea behind alternative investments is to diversify a portfolio and potentially achieve higher returns or hedge against market volatility. However, alternative investments often come with higher risks and are less liquid than traditional investments. They may also require specialized knowledge and a long-term investment horizon. It is important to carefully consider your investment goals, risk tolerance, and overall financial situation before investing in alternative assets, and to consult with a financial advisor. Collectibles are a diverse range of objects that people collect for various reasons, including their rarity, historical significance, cultural value, and personal interest. Some of the most popular categories of collectibles include stamps, coins, books, art, toys, vintage fashion items, sports memorabilia, music, film and TV collectibles, and military memorabilia. Stamps issued by governments or other organizations often feature unique designs and images that make them appealing to collectors. Coins, both old and rare, are also highly sought after by collectors due to their historical and cultural significance. Books, especially rare or first edition copies, as well as books signed by the author, are popular with collectors who are interested in literature and the publishing industry. Art, including paintings, sculptures, and other works by famous artists, is another popular category of collectibles. Toys, particularly vintage or rare ones, are also highly collectible, as they evoke feelings of nostalgia and remind people of their childhood. Vintage fashion items, such as clothing, accessories, and textiles from past eras, are also popular with collectors who appreciate the style and history of fashion. Sports memorabilia, including signed jerseys, balls, and trading cards, is another popular category, particularly for fans of sports and athletes. Music memorabilia, including records, posters, and instruments, is popular with music lovers and fans of musicians. Film and TV memorabilia, such as props, costumes, and other items used in the making of movies and TV shows, is popular with fans of the entertainment industry. Finally, military memorabilia, including items related to military history such as weapons, medals, and uniforms, is popular with collectors who are interested in military history and the role that military has played in shaping the world. This list is not exhaustive, and there are many other types of collectibles that people may be interested in collecting. The possibilities are endless, and if there is more than one object of a similar nature, produced differently, someone out there could be collecting it. Collectibles can be a good investment for some people, but it's important to keep in mind that the market for collectibles can be highly unpredictable and subject to fluctuations. While some collectibles have appreciated significantly in value over time, others may have decreased or remained stagnant. It's important to do thorough research and understand the market for the specific type of collectible you're interested in before making an investment. It's also important to consider factors such as rarity, condition, and demand when evaluating the potential value of a collectible. In general, collectibles can be a good investment if you're passionate about the item and willing to hold on to it for the long term. However, it's not a guaranteed investment, and there are no guarantees that the value of your collectible will increase. cryptocurrency is a digital or virtual asset designed to function as a medium of exchange and store of value. Cryptocurrencies use cryptography to secure and verify transactions, as well as to control the creation of new units of a particular cryptocurrency. Bitcoin was the first and most well-known cryptocurrency, and since then, hundreds of other cryptocurrencies have been created. Cryptocurrencies operate independently of a central bank or government, and transactions are recorded on a decentralized ledger, known as a blockchain. Cryptocurrencies are traded on various online exchanges and can be bought and sold for fiat currencies or other cryptocurrencies. They offer several advantages over traditional currencies, including lower transaction fees, faster transaction times, and more anonymity. However, the cryptocurrency market is highly speculative and subject to rapid price changes. It's important to thoroughly research any cryptocurrency before investing and to be prepared for the possibility of losing your investment.
Tonight, the once crowned king of crypto, now adorned in handcuffs. Former billionaire FTX founder Sam Bankman-Fried, arrested in the Bahamas today following the historic financial collapse of his massive cryptocurrency exchange.
Additionally, cryptocurrency regulations vary by country and can be subject to change, which can affect the value of your investment. It has been designed to offer several advantages over traditional fiat currencies and has been adopted by a growing number of individuals, organizations, and businesses. One of its key use cases is as a digital medium of exchange for goods and services, just like traditional currencies. Additionally, some people see cryptocurrency as an investment opportunity and buy and hold it with the expectation that its value will increase over time. Another use case for cryptocurrency is cross-border transactions. By using cryptocurrency, individuals can make cross-border transactions without the need for a middleman or conversion to a local currency. This offers significant benefits in terms of speed, cost, and convenience. The decentralized nature of cryptocurrency has also given rise to the development of decentralized finance, DeFi applications, such as loans, savings, and insurance, that operate without intermediaries. Cryptocurrency is also being used as a payment method on online marketplaces, providing an alternative to traditional payment methods such as credit cards or bank transfers. Transactions made using cryptocurrency can offer a higher degree of privacy compared to traditional payment methods, as they are not linked to personal information. This makes cryptocurrency a popular choice for those who value privacy and security in their financial transactions. Another advantage of cryptocurrency is its ability to facilitate micropayments, or small payments for online content or services. This is due to its low transaction fees, which make it feasible for individuals to make small payments that may not be possible with traditional payment methods. Finally, cryptocurrency can also be used for charitable giving, allowing for more transparent and efficient giving, enabling individuals to make charitable donations without intermediaries. Altcoins are alternative cryptocurrencies to Bitcoin, which was the first and most well-known cryptocurrency. Altcoins are digital assets that are designed to function as a medium of exchange and store of value, just like Bitcoin. Some of the most well-known altcoins include Ethereum, Ripple, Litecoin, and others. Altcoins often have different features, technical specifications, and use cases compared to Bitcoin. For example, some altcoins may have faster transaction speeds, lower fees, or different consensus mechanisms. Some altcoins are also designed to address specific real-world problems, such as improving supply chain management or enabling secure and private transactions. Investing in altcoins can be risky, as the cryptocurrency market is highly speculative and subject to rapid price changes. As with any investment, it's important to thoroughly research an altcoin before investing and to be prepared for the possibility of losing your investment.
Luna, do you have time to sing a goodbye song before you go? Always there. Hey, this was really fun. We hope you liked it too. Seems like we've just begun when suddenly we're through. Goodbye, goodbye, good friends, goodbye. 'Cause now it's time to go.